seems to be enjoying a golden run. Can equities get a golden run going? Aniruddha Sarkar, co-founder and CIO of Equinova Investment Managers, his new outfit, is with us in the studios. Aniruddha, great having you. Thanks for taking the time out.
Yeah, thank you, Neeraj.
I know the pleasure is ours, and wishing you a happy 2026. Could it be a happy 2026? And the two men who look at gold, silver very actively are saying that the returns could be good. Investors will say, "Aur kyun paisa kyun dale equities mein?"
No, I think it's good to begin. I would say it's good to begin the year on a very kind of expectations being extremely low. But I think after seeing the last year, I think what I can say is that definitely equities and all the specific Indian equities is going to outperform the global markets. And the reasons are not like, I'm just making a statement in the air. I think they're enough kind of the foundations which have been put in the last year. When you talk about the tax benefits, you talk about the GST cuts which have been taken place, also the labor reforms which has happened. I would say definitely after seeing the mid-single digits to high single digits kind of an earnings growth the last year, expecting mid-teens to high teens kind of an growth in this year is what will drive the equity returns in Indian markets.
In your opinion, from this stage, if you were building out a portfolio right now, do you think going broader and having a larger number of stocks would be better than having a concentrated number of stocks because you're not sure at what point which sector and which stock is going to take off?
I think this debate of, the number of stocks ideally you should have is something I've been having with investors for ages. So there is no ideal number, what is the right number.
But I was asking for your opinion.
Yeah, so I always believe in having anywhere between 18 to 25, I would say the ideal number of stocks to have in the portfolio. So that takes care of your concentration as well as the diversification. Now within this 25 stocks, I would say bet more on the names where conviction is high. So your top 10 can make up like, 45 to 50%. The remaining 15 to 18 stocks can make up the rest. So that takes care of your concentration as well as your diversification.
And how are you constructing that 25 right now?
So in my concentration portfolio, if I talk about my top 10 stocks, that would make up like roughly around 52% of the portfolio at this point of time. And more important is which sectors you're betting on. And that is something which I always keep telling investors, and that gets reflected in my portfolios also. Sector selection is very, very important. Then comes which company you buy within that industry, because you might be buying an excellent company, but if that sector is not going to see the upside of an overall earnings upcycle, very difficult to make money over there. You will have some outliers always, but then it's much easier to pick the sector right, then pick up the company in that industry. So we talk about the sectors I'm betting on. I think, in fact, that's my view for the year. In fact, most of the time last year, we used to talk about being optimistic, but very kind of the cautious optimism. That was a very kind of a statement we used to hear, cautious optimism. This year, I'm saying it's good to be a bit selective aggression. Selective aggression is required. Where do you bet on? I think industrials and capex is one big theme which will play out. It's been my top bet for, I would say, the last 8 quarters, but I think you'll see the earnings momentum much bigger in the industrials and the capex. BFSI is something, if I see post-COVID, a large part of my portfolio used to always underweight of banks. I used to be more overweight on the other financial services linked to the capital market play. This time around, I'm getting a bit overweight on BFSI, which includes capital market play and banks and NBFCs. NBFCs is something I used to avoid, but I think with the rate cuts which has happened, I think you are going to see a lot of growth happening there. So yes, industrials and capex making a big part. Second is BFSI, and the third is urban consumption, urban and the rural consumption. So these three will make up roughly, I would say, 90% of my portfolio. Very underweight on IT, and I've been underweight on IT for a long time. In fact, for almost 6 to 9 months, I didn't have a single IT stock in my portfolio. And though index had like, 14% exposure, but, not having a single IT stock, definitely you're betting against the index. But that helped. I'm more bullish on the mid and small cap IT, and that is where I'm allocating as of now. That's done well. And I think you're seeing a lot of management changes in many mid and small cap IT. And typically, if you pick up any mid and small cap IT, management changes leads to a good earnings upcycle. So these are the broad areas where I'm allocating, and I would say again that, you have to get a bit aggressive in this year.
Yeah, so this selective aggression, I like that term, might just be the theme for 2026. What are the kind of returns that you have sort of penciled in? at the end of the day, and we were having this conversation off cam before we started, that's what investors will come and ask. Okay, so what are the returns that we can expect? And I think we've gone through now a couple of years of expectation management.
So I think the good part of the last year is that, expectations have been brought down drastically. So there used to be a time, post-COVID again, that, when you talk about, making 18-20%, people say okay, at least 25 to 30% return should be there. This time around, I think after the last year's return, people are expecting anywhere between 12 to 15%. But I would say I always link the return expectation to the earnings upside, which is possible. So typically, if your headline index, if I talk about the large cap index, 14 to 16% is what I would say the broader consensus is, earnings growth. 4-5% alpha over the earnings growth, I think one can expect in this year, which if you add up anywhere between 18 to 20%, I think one can make up in this year. But yes, that is again, if you're selectively picking the right sectors and the right companies in that space. Other view, which I am very confident of, is that, I don't know if that's a consensus at this point of time, but I'm sure it's the other way around. Mid and small cap will outperform the large cap. And this is one space where I see, again, earnings growth in the mid and small cap will be much, much higher compared to the large cap. Like if I just look at a headline index, large cap index can give you around 14 to 16% earnings growth. Mid cap index can give you around 20 to 22% earnings growth. Whereas the small cap index has the potential to give you around 24 to 25% earnings growth. So a portfolio which is actively selecting the right mid and small cap can massively outperform the headline, the large cap index in this year. So that answers your question about the returns expectations.
Within that, and I'm just going to, you talked about all of the sectors where you are selectively aggressive. You didn't quite mention consumption and specifically internet companies or platform companies, more and more of them to select from. None of that interests you?
No, definitely. So I have been a investor with Eternal for a long time. And I think if I talk about consumption, that's one name which comes to the mind.
Of course.
And when I talk about consumption, I'm betting on both urban and the rural consumption. Within urban consumption, one part is the new age companies, like your Eternals, the new age companies which are there. The other space where I'm betting on in a big way is auto and auto ancillary. Because I think if you go by all the numbers which has come out from the auto industry, I think it's giving a picture that this is not just a pent-up demand.
Is it PV or CV though?
I am betting more on the passenger vehicles and the bikes and the scooters, because I think if you look at the benefit of the tax cuts, is going to go to that segment which is going to be a big consumer of your bikes and the scooters. And if you go with the auto sale numbers of your Bajajes and the TVS and the Heroes of the world, I think that's giving a picture, a type of growth.
Sorry.
No, but just a follow-up there. The monthly numbers that we see, Aniruddha, commercial vehicles, tractors numbers have been rock solid.
Yes,
so
absolutely,
why are you
absolutely.
omitting that bucket?
No, I'm not omitting. So basically, I'm playing the CV space with auto ancillaries.
Okay.
With auto ancillaries, and the OEMs I'm playing with the passenger vehicles and your the two-wheelers.
I was going to ask, if you were to put a bucket on auto and you were to subdivide between OEMs and ANGs,
Right.
how do you subdivide it?
So I have, like if you talk about the portfolio exposure, I would have two names in the auto, in the two-wheeler space. One name I have in the CV space, in the OEM, but I would have, say, around 4 names in the auto anchs. So that's the kind of broad space, because the auto anchs, what I'm seeing is that many of the auto ancillary companies, they have diversified towards aerospace. Typically, if you look at the auto components, the way you make an auto component is not very different from the way you make different aerospace components. Just that your level of quality has to be very high. Now, after several years of R&D, many of those companies have actually gone into aerospace, and there are some companies which have got big orders from Airbus. Now, that is giving me confidence that if you're betting on those auto ancillaries, you're actually diversifying your risk also, not just on your autos, but also into your aerospace.
Which are these? We don't want a buy-sell recommendation, but which are these which have actually transitioned that successfully?
So you have names like Sansera, you have names like Dynamatic Tech.
But Dynamatic Tech was never an auto company, right?
Not auto company. Yeah. It was never an auto company, but I'm saying they have transitioned over the years.
Okay.
But now what has happened is they used to work in that space. They have got big orders from Airbus now for the next 8 to 10 years. That gives you a visibility that their top line, which has been constant for last many years, is now going to double in the next 36 months. So that's a kind of growth which can happen in those companies.
Okay.
A very quick question, and this is the last one. You mentioned IT as a pack that you've avoided. Is there anything else that is a strict avoid for you at this moment?
So I typically don't get into companies where too much of government policy intervention can happen, because that takes your...
You like defense?
Defense, yes, definitely. I like defense. In fact, when the whole defense theme had picked up, I would say a couple of years back, I was an early entrant there. But then I exited because valuations again went over the roof. You could not justify a 40p for a defense company, or even a 60p in some cases. As we stand today, definitely defense is, I would say, one area where I'm betting on, but very selectively. In fact, we are evaluating some names in the private space, because all the PSU names definitely are not something, they have run up and valuations are expensive. We are selectively looking at some private companies in the defense space. But yes, defense as a theme is a multi-year theme for sure.
Wow. Aniruddha Sarkar, it's been a pleasure speaking with you and having you here.
Always a pleasure.
Fantastic.